It is a great pleasure to welcome to Best Ideas 2024, returning MOI Global instructor, Bob Robotti. Bob is the founder, president, and chief investment officer of Robotti and Company Advisors, a registered investment advisor based in New York City. And though I'm sure everyone tuning in knows Bob quite well by now, I do want to give a bit of an introduction to him and the firm. Guided by the classic tenets of value investing, valuation matters. Robotti and Company uses a proprietary research approach to identify companies which trade for substantial discounts to their future free cash flows, yet are misunderstood, neglected, or just out of favor, so discounted by markets. Once identified, Robotti's investment team focuses on deep primary industry and company research to select investment holdings through the lens of a long-term business owner. In this capacity, Bob is currently on the boards of AMREP Corporation, Pulse Seismic Data, for which he also serves as chairman, and Tidewater. Bob previously was on the board of BMC Building Materials Holding Corporation, now amalgamated into Builders First Source, the premier and differentiated distributor of building structural products to home builders. Prior to founding Robotti and Company in 1983, Bob was the CFO of Gabelli and Company. Bob holds a BS in accounting from Bucknell University and an MBA from Pace University. Bob, you have been such a great mentor to me and members of MOI Global. Truly grateful for you sharing your wisdom and experience and ideas so freely with the MOI Global community. Thank you so much for that, and thank you for joining us again today. And now I'd like to turn it to you. Please go ahead.
Hi, John. Thanks so much. It's good to talk with you, although disappointing I can't see you because it's been a long time since we've seen each other. So thank you so much for inviting me to talk to the MOI Global community. It's a great opportunity, and we're excited because it's an exciting time. We think there's a huge number of opportunities out there that are extremely interesting, and a basic concept that permeates a lot of our investing is this idea that old economy value with a new economy upside, and therefore there really is a transformation of a lot of businesses, and they're very different than investors used to think of them, did think of them based on past results, but businesses really do change. Economics 101 does really work. So the firm is really all about bottom-up stock research, right? We are value investors. We believe that if you do fundamental research on businesses, you can understand those businesses and get to identify certain companies that have a latent earnings potential that's significantly greater than what the current market price of the stock is. I had the good fortune getting into this business, graduating college in 1975. I walked into the door of Tweedy Brown to do the audit and was there for 4 years and met the people. But timing is important. Cycles really happen. So 1975 also was, post the 73, 74 market crash. And there was a significant rotation in what stocks you wanted to own. And small cap value were the things that really were compelling. And I think that there's certain analogies to kind of the current environment we're in. And of course, 1975 is really the beginning of that time period. So, Tweedy Brown, Gabelli, who, you identified at work for a couple of years, Mike Price Mutual Shares, that we all know, really that was the starting gun for the takeoff that really happened in value investing. So it was a phenomenal time for me to walk into the business and therefore to understand how they thought about investing in that investment approach, because it's fundamental to what we do today. Here's some history of the information and kind of the progression of the firm. And one of the things I really like to highlight is, so it identifies some of my colleagues that I think many of you know well. So Isaac Schwartz, Curtis Jensen, David Kessler, Theo Vandermeer, and then of course we even have second generation. So Brian Weber, the son of Alan Weber, and Spencer Sibeli, the son of Mario Sibeli. So people, and that's what it is. The firm has done a phenomenal job, I think, in accumulating like-minded investors who think about investing and understand the market's inefficiencies and spend time and effort and revel in the idea of finding a mispriced security and therefore identifying those things and investing our capital in those. So that's a unique asset that I think the firm has, especially since much of value investing and even the legends have either grown older, grown away from value investing, or just gone away. So therefore, the universe today, we think, is one that's particularly appropriate and strong, given there are many fewer, if any, practitioners in the way we've been doing value since the way Tweedy and Gabelli initially did and all those people. So it's an interesting time. The field is winnowed out substantially. When we invest in companies, we really get involved with the company and understand the industry, the company extremely well, develop a relationship with the management owners, and therefore that's a fundamental piece. And therefore, these are long-dated potential opportunities, we think. In spending time looking at these companies, frequently companies that nobody else is talking to. So it's not like you're crowded and it's tough to get the attention of the CFO or the CEO because no one else is really calling them, because many of these businesses are beaten up and out of favor. So therefore, it's an easy process. And therefore, getting to know them is critical to understand the business and understand the opportunity and understand those managers and how they allocate capital, which is a key critical ingredient for the potential long-term success of these businesses. As part of that process, we do identify here that because of that long relationship and that cooperative collegial relationship with those boards and managements, frequently we end up serving on the boards of these companies. And here's some of the companies over time that we are on the board of today or were on the board of in the past that are significant investee companies for us. A critical element to our investment process really is Schumpeter's process. So it really, what it talks about, of course, is that businesses that do well attract new capital. New capital is new capacity, and that has the risk of therefore supplying too much. And of course, therefore, you can't get a return on capital because you've oversupplied the industry. And then that process starts of cathartic recovery. So therefore, businesses then decline, investment declines, industries consolidate, firms exit. So that cathartic process really is, that's what we're looking for, companies that are going through that kind of readjustment to a new economic reality, a depressed economic reality. And then from that environment, there's the opportunity when that business then starts to recover, there really is high returns on capital. And therefore, that's where you really want to be invested, in that bottom of the cycle. And I think that that's a differentiator. So even in the bottom of that cycle, when that's happening, that's what we're doing, is looking at this business is one in which what they make is a critical product, service, and therefore has long-term viability. And therefore, the cycle will turn and they are going to be extremely well positioned. And if we can identify companies that are well positioned at the bottom of cycles and can be opportunistic, that's a critical fact, because we're not looking to buy the business just because it's depressed. What we're really looking to do is buy businesses that we think have substantial growth, not only in the cyclical recovery, but in being opportunistic in the downturn. And that's what history has shown, or successful investments have done that. And that's one of the things also is critical, is the ability to kind of continue to stay invested with these businesses, right? Because here, it goes through the cycle of what happens internally in the businesses and how the industries morph. But of course, down in the bottom line, it says what investor responses are. So of course, when things are great, there's investor enthusiasm. But then when there's an overcapacity and margins compress and business starts to decline, the shares underperform. But what we're really looking for is when it really is investor pessimism or investor apathy. Who cares? It's never going to recover again. I know that business, and so it's no good. And so therefore, that's why. And when that happens, stock prices tend to stay flat to down. So therefore, the price becomes more depressed when the recovery doesn't happen. It takes longer. It's more problematic. And so what happens is that the business becomes cheaper and cheaper, while the process of cathartic recovery is making the business a better and better business with fewer competitors. So that's a key critical element in a repeated pattern of the things we've had success in. And a critical element is the ability to kind of understand that, not worry about being too early sometimes, but also the ability when that business starts to recover, there's a real opportune time to potentially deploy a lot more capital as the process plays out. So over the last couple of years, I'm sure people have heard the phrase "revenge of the old economy," and what it emphasizes is that the macro really does matter, right? Value investors always talk about, well, I don't know what the macro is going to be, and so therefore I discount that. I put that aside, and part of my fundamental research is I look for businesses and I have a margin of safety because I don't know. The fact of the matter is, what we think is two things. One is it's not the revenge of the old economy. It's really the metamorphosis of many of these old economy companies. So there's a lot of things that have changed over many successive cycles, including, there's been the most important thing in the world economy in the last 40 years has been the ascendancy of the economy in China. And repeatedly through these cycles, industrial businesses in North America, as in other parts of the world, were competitively disadvantaged. And so that meant these industries today, we think, are very different with a very different industry structure, but also two critical elements. So our research, our bottom-up stock research, Theo Vandermeer, identified this idea 8 years ago as grassroots macroeconomics. When you understand something about a business and industry, you can identify certain macroeconomic trends that are clear, obvious. And fortunately, Rudiger Dornbusch, a professor from MIT, is known for a phrase, and that is, in economics, things take longer to happen than you think they will, and then happen faster than you think they could. So that's a critical thing. Things take longer to happen than you think they will. Investors become disillusioned, disappointed, and therefore move on, as opposed to we really do think that there are economic factors that are clear. And so two factors from our fundamental research that we think are driving the next decade plus in terms of where to be invested and who has a huge tailwind. One of them is this concept of globalization 2.0, not just China. So it's not deglobalization. Globalization is continuing to evolve and it's changing and morphing. And part of that process is other countries are competitively advantaged now versus China. And so therefore, places like India, Southeast Asia, clearly look as if they're beneficiaries and have been for a decade. Businesses have been migrating out of China in many cases to these countries. And we think that process clearly is, for a multitude of reasons, accelerating. So that's an interesting process that is going to be really, the capital cycle is important. Capital spending in all of those countries and the growth of those businesses and the growth of the energy consumption likely in those countries are critical elements. The other part of globalization 2.0, not just China, is, of course, people say we should be competitively disadvantaged. In many cases, many industries, especially industrial businesses, North America is competitively advantaged. And therefore, it's not China who's moving businesses here so much. It's as much Europe realizing their competitive disadvantage, and the advantages of North America are migrating to North America in large part, including Chinese companies, right? We all know that the 3 EV companies are anxious to move in and head up operations in Mexico to be part of that North American market. They're, Nippon Steel taking over US Steel. So there's plenty of indicators that the rest of the world identifies the fertile opportunity that exists in North America. And the second thing that we think is a huge macro factor is, I'm sure all of you know that we've been investors in the fossil fuel industry since pretty much the inception of my investing in 1976. And so we do think that energy transition is a clear, obvious, important macroeconomic event. And what that is the growth of renewables makes all the sense in the world. And the world will grow renewables as fast as they can. The fact of the matter is, you just can't build out the renewable to displace the existing energy infrastructure fast enough. But it also means that the capital cycle in building out those renewables is critical. So the call on traditional things like steel, cement, copper, all of these things, which are already in relatively tight supply, means that it's an interesting dynamic that it really is transforming a lot of companies. And we think that's critical. And that's, of course, part of the driver why there's reshoring or the movement of many companies from around the world to set up operations in North America, is because we have the lowest cost energy, and that's a sustainable competitive advantage. energy-intensive businesses in North America are competitively advantaged. Natural gas and its abundance in North America means that we have a long-dated disconnection from the rest of the world in terms of energy prices. So natural gas here is substantially less than it is around the rest of the world. And if it goes up in Europe, it may go up here, but the differential continues to be significant and dramatic and continues to drive economics, improvements, competitive advantages to North America that are long-term and sustainable. And so that's another critical element of kind of how we think about investing and where we think there's a lot of opportunities that people are not paying attention to. And here's a chart right on the right-hand side that goes through gas prices in Asia, gas prices in Europe, and gas prices in North America, and how there's a significant differential. And even if as you get volatility, and it may come back down, because there's two things. Of course, one is the price differential because we have it, but it also, in addition to an economic advantage, there's also the ability and the advantage that we have a secure source of supply. Other parts of the world import critical elements of their energy equation, and therefore that the security is something that is at issue in many of those places. And so therefore, it's not only that it is low cost, that it is secure and reliable and sustainable and defensible. So in addition, of course, to the advantages that come from that, these economic now suddenly advantages for North America, the Inflation Reduction Act is something that will accelerate the capital spend, the capital call, the call for commodities broadly in North America as we build out different industries and rebuild those industries. And of course, it's not the Inflation Reduction Act, it's the Inflation Accelerant Act, I would suggest. And yet much of the spending that's coming from this is still coming and still partly there, and therefore there's a huge momentum with a long tailwind for a significant amount of time. So that's what we believe, right? In terms of energy transition, the key element is, we haven't invested in the historic. We've cut back on electric production from fossil fuel sources that therefore do create CO2 as we build out renewables. But again, we just can't build out renewables fast enough. In addition, that globalization 2.0, not just China, and the advancement likely to continue and start to accelerate in Southeast Asia and India. Historically, every country, as it starts that economic ascent, starts to become extremely more energy intensive. The energy demands of both of those places will absorb a lot of capacity that is needed to be added. And so therefore there's a huge capital spend. And one of those things, there are many things that we think also in energy transition are changing from the historical uses and having suddenly new uses, new applications, new end market demand, and therefore creating significant growth opportunities. And the company we're talking about today, LSB Industries, is the intermediate product they produce is ammonia. And ammonia is one of those commodities that is turning itself from what it has traditionally been, and it's mainly used for fertilizers, and it's used for other industrial purposes, including actually making explosives, and those explosives aren't for military purposes. That's aggregates, industry, mining. These things are continuing to increase in terms of what the demand is, and therefore increasing demand for the traditional uses of ammonia. But more importantly, are the uses of ammonia for new purposes and as a substitute for fossil fuels, because when it burns, it does not create CO2. So LSB Industries, the stock's probably, as you say here, it's under $8 a share, down from in 22 when this company was minting money, 28. So it's probably down 70% from its high. And therefore we think extremely opportune today and extremely mispriced and undervalued. In 22, when they minted money and the business was extremely strong, the free cash flow also did something to transition the business from being one that was a debt-heavy company to one in which there's a significant amount of cash on the balance sheet and relatively modest amount of net debt and free cash flow. So therefore, it has access to capital on its own balance sheet, and it also has access to the cash flow that it has. So therefore, the ability to invest, because we think there's a lot of opportunities for relatively modest investments with high returns to build out, debottleneck, their existing business. And what you do see, of course, is this is a cheap stock, we would say, right? On a trailing basis, trades for 6 times its trailing earnings. And why is it so cheap? Because earnings have gone through a cyclical period and are constrained right now, and therefore the forward earnings number the past years is 15. So therefore the stock's earnings are weak, and that's what makes for opportunities. Weak earnings, people ignore the 3 to 5 year opportunity, ignore the value of this business, and therefore sell it based on the fact that they are concerned about the short term. And those short-term concerns exacerbate and heavily discount the fear creates the opportunity, right? Value investors, fear, greed, those are things that do exist. We know those emotions, and that's a critical part of why we think there's an opportunity here. Here's a chart that shows the location of their 4 facilities, and the ones that actually produce ammonia and sell them into the fertilizer business or other industrial uses are extremely well located. So it's a companies that has assets in the right place, but in the right place. Let me digress for a moment to highlight the biggest in the right place. The biggest in the right place is these plants are in North America. Natural gas in North America is competitively advantaged and discounted from the rest of the world. That is the key raw material to make ammonia and then to make fertilizers. They're competitively advantaged, and there's outsized earnings, which is sustainable for an extended amount of time. That's the critical element of what you get here and why this business is really so opportune today and mispriced. Here are some of the key products and markets, the applications. If you look on the left side, you notice that a critical market is agricultural. That is the fertilizer business, which is a cyclical business, and therefore that's part of why the stock historically has been cyclical. The industrial part of it, which is more sustainable. The mining part of it, again, which is a growing part of the business that is absorbing more and more of the production. And here's a chart that, again, breaks out some of their products, the markets they sell to. And then, of course, the industrial part of the business tends to be more on contract and therefore not quite as volatile. So therefore, it reduces a little bit of the volatility that historically the earnings have had. So the cash cost per ton of ammonia is a critical advantage that is just the sustainable advantage, and why this company will earn over the next few years outsized returns, and those outsized returns are sustainable. And so on the right-hand side, it identifies the differential in the cost between TTF, and TTF, right, is the Dutch indice that is the Dutch equivalent to the Henry Hub. So, a quoted price for natural gas in Europe. And of course, it's the input price to make ammonia makes it substantially more expensive. On the other chart shows anthracite, which of course China uses as their raw material. And again, anthracite prices in China are substantially higher, and therefore their cost to produce ammonia is substantially above North American producers. So there's the huge competitive advantage, and which means for high returns on capital for the foreseeable future. And what also has happened is, the European production has been troubled not only by 2 things. One is the security, the availability of natural gas to make, but also concerns about pricing and economics. So therefore, at various times, a lot of the capacity has been taken offline because it's just not economic to make fertilizers in Europe, given the high natural gas price. And that's a sustainable headwind for the Europeans. And what are the Europeans doing as a response? They are building, of course, here in North America. But in addition to all these advantages, we think that the Inflation Reduction Act really does accelerate the advantages that LSB and its competitors domestically located here have. And then that is by sequestering the CO2 that comes out of the production of ammonia. Therefore, you could substantially reduce that CO2 footprint by capturing it and sequestering it. So therefore, the Inflation Reduction Act has a credit in it, the 45Q, which enables any CO2 that's sequestered permanently to therefore attain this credit. What that does is it makes not only the economics of ammonia production in North America competitively advantaged, it makes blue ammonia probably even more competitively advantaged against regular ammonia production if you can identify the capability to sequester and store the CO2, because the chart on the right-hand side demonstrates that actually with the credit, it reduces the cost of ammonia production, and the ammonia produced is blue ammonia, lower carbon ammonia. And therefore, there are plenty of people who buy ammonia who would hope to substitute blue ammonia, lower carbon ammonia, and therefore probably create some uplift in terms of the price and the profitability that you can get from doing that. LSB is fortunate because one of their largest location is located on a site that has an aquifer below them, or actually a depleted resource. It's not an aquifer, it's far below that, that you can sequester carbon at permanently. And so therefore its transportation costs are de minimis. Its sequestering costs are non-existent because it's on their own property. So therefore the incremental costs that many others will incur are not incurred by LSB. And so therefore we think by the end of 2025, that's what they'll do, is capture a significant amount of the CO2. We think the project to do that will be economic with returns. There's no capital that a company needs to put up. It's an elective process. They could participate in the economics and yet make a product that will sell for a higher price because it has less carbon in its production. So energy transition is changing the business for ammonia in its own right and competitively advantaged North American producers, given North America has a significant amount of depleted wells from historical production that you can sequester carbon in. It has an infrastructure that you can move carbon around in. So therefore, it's competitively advantaged against many other places to be a place where you can sequester carbon economically. And here specifically on LSB is their blue ammonia project in El Dorado. There's a green ammonia project that they're working on in Pryor. It's much smaller in scale, but testing that out. And green ammonia is ammonia that is made by using a renewable energy source to make the ammonia. And so therefore they're using wind and solar in Oklahoma as a test for this to work. In addition, what they've done is they have an agreement with a company that's using engine technology to change the engine technology in the fuel burn to use ammonia. So the technology is one in which they use ammonia. Ammonia is therefore transported and then converted into hydrogen. And then the hydrogen powers a fuel cell that therefore powers the vessel. So they eliminate the use of fuel and therefore the burning of CO2. And the marine industry is one. IMO is an organization that's been pushing for substantial changes in what the power generation is to clean up, to reduce the amount of pollution that comes from marine, which is a significant cost. And so here's a technology that potentially substantially advances and increases dramatically the demands for ammonia and its usage. As I said, what is the European industry doing? The European industry is moving to North America, given those long-term opportunity and those advantages from lower cost feedstock, natural gas here. So Yara is one of the largest fertilizer companies in the world, one of the largest merchant seller of ammonia around the world, and sells significant amount today imported into North America, is in the process of building new facilities, 2 new facilities here in the United States that will produce ammonia, sequester the carbon, and therefore have very strong economics to take advantage of the North American advantage that LSB already has because it already is resident here. Here's CF Industries, which is the largest player in the fertilizer business in North America. And there's the multitude of projects that they've identified that continue to advance and get really high economic returns. And therefore, this is just an indicator of some of the opportunities that LSB has in front of it. And then in addition, OCI, which is a Dutch headquartered company and has operations here in the United States, is also fast-tracking a project to build a blue ammonia project, taking advantage of North America's competitive advantage, which is resident in all of LSB. As I mentioned, what's really happening is energy transition, and energy transition, part of that is there are 2 aspects, right? One of them is carbon sequestration, which the company is taking advantage of to reduce the carbon footprint of its ammonia production. But the second one really is a much bigger opportunity, we believe, and that is alternative uses of ammonia. So the first one I already identified was the maritime shipping business. So the large engine, marine engine companies are testing various engines that burn ammonia. So therefore, to be able to build new vessels with a dual fuel that burns both fuel oil, but also ammonia is a obvious technology that's advancing that has a huge end market potential in terms of ammonia consumption. The second one is power and electric generation. So specifically, the Japanese and South Koreans are already doing pilot tests. And what they're doing is they're blending they're blending ammonia along with coal to 20%, 30% reduction in the coal burn. So obviously, when the ammonia is burned, it doesn't create CO2 as the coal would, and it doesn't create all the other particulate matter associated with that. And so this is an obvious potential that actually is relatively easy. The marine business, you need to retrofit, or build new ships with engines that have the capability to burn ammonia. That's a longer timeline to unfold. Here, potentially without much change to the infrastructure in place, you can blend in ammonia and reduce the amount of coal you burn. So a substantial new opportunity. And then storage and transportation and hydrogen. Hydrogen is obviously one of the things that everyone is hoping is a effective substitute that will reduce the CO2 production, and therefore yet something we can burn to create energy. However, the infrastructure to move hydrogen is extremely limited, and it's extremely difficult to move hydrogen. Now, it's not easy to move ammonia, but it's something that there's a well-established infrastructure and technology and knowledge. And so therefore, there are a number of projects that are using ammonia as a bridge with the conversion to hydrogen. So it's part of the facilitator of potentially making hydrogen more prevalent and usable, is to connect it with ammonia. For example, in Qatar, they're building a huge plant. I forget if it's 2 or 3 million tons a year of ammonia production, with the intent of therefore exporting that ammonia, bringing it to Europe, converting the ammonia to hydrogen, and therefore using the hydrogen as a substitute for fossil fuels. So there's a number of projects around the world that are working on that bridge between ammonia as a facilitator to the use of hydrogen, that also create new end market demands for the intermediate product ammonia that LSB and its competitors make competitively advantaged at lower cost in North America. In addition, its core markets, the fertilizer markets, there's a number of dynamics that would seem to suggest a strong market for LSB, including higher corn prices, but also, of course, natural gas prices in Europe, which will set prices for the fertilizer product at being at much higher level, and therefore expanding the earnings potential of North American-based facilities. In the meantime, new production coming online is less than the expected growth in the traditional markets, let alone these new markets we're talking about. And what's happened is, because the short-term earnings for the company have come down, and therefore there's uncertainty on them and all of those things, everybody runs for the door and they exit because they don't know when that might turn. And that's happening even now again, right? Natural gas prices in North America and Europe have had a little bit of a subsiding, and therefore have come down some. And so therefore, that starts to set the price for the European producer, and it starts to set the price for fertilizers, and therefore earnings are coming in a little bit, and there's concern about that. The fact of the matter is, this chart highlights the fact what we're looking for in these industrial businesses that sell far below the replacement cost of the asset. That asset is one that people are in the process of replicating, because it is North American-based ammonia production, competitively advantaged, and inevitably in a period of excess outsized earnings. Here are vindications of the valuation. That's what we think is the replacement cost of this company, of these assets, probably are 3 times the current trading price of the stock. And here's some indicators. So CF Industries, the largest competitor in the business, is in the process of buying a plant down in Louisiana, and therefore it's about $1.7 billion purchase price. It's around 880,000 tons of capacity, so around $2,000 a ton of capacity, which is the industry recognized number for what does it cost to build an ammonia plant in North America. So therefore, an indicator of what value is by a transaction in the open market. In addition, there's a recently announced deal for Coke Coke is buying a plant in Weaver by OCI, and therefore it's a much bigger purchase price. It's $33.6 billion. And again, that works out to about $2,000 per ton of capacity. So two transactions, and I would suggest CF is a well-run company that's smart and in a strong capital position to be opportunistic, being opportunistic to buy that plant. And I would say that Coke, people may not like the Koch brothers. We all know that for various reasons, but the fact of the matter is people don't think the Kochs don't know how to make money, and it's their money, and therefore they're allocating capital. So smart people are buying assets and paying prices that indicate the asset value of LSB's assets are substantially a premium to the existing company. In addition to the fact that we've seen in the recent years, the earnings potential of the business demonstrated that, again, shows it sells far below what the asset value of the business is. Here is a chart that goes through what the normalized earnings of the business we think are. But importantly, there's three different projects in front of it with almost no to low capital cost that therefore expand and increase the by 25% the normalized earnings of the business. There's also an identified projects for a debottlenecking, which again has a high return on capital. And again, a company that has access to its own capital and free cash flow to therefore fund that, and therefore the potential to increase the normalized earnings of this business by 50%. Importantly, as part of the opportunity that is developing and exists in ammonia is the joint venture they recently announced that they're doing work on studies to build a new plant in the Houston Ship Channel. On the right-hand side, that's the Houston Ship Channel. So extremely well located with therefore transportation around the world. And their joint venture partner is Inpex, a Japanese a Japanese oil and gas company that is active in the LNG business around the world, including off of Australia, and sells that to the utilities in Japan and Korea. So therefore a long-dated relationship with those people, believes that ammonia is going to be one of the fuels used by the power industry. And so therefore they've announced a joint venture to potentially build a $1.1 million low carbon ammonia plant, blue ammonia plant, where they're going to sequester most of the carbon and capture that. And with the idea that the utilities that they can get in Korea and Japan will use it on the test burns they're already doing to blend it with coal to reduce their coal burn, and therefore enter into long-dated contracts and opportunities. Likely that's going to be a cost-plus deal. So there's the low-cost, long-term access to natural gas in North America as the feedstock, therefore with a cost-plus arrangement to make ammonia, to therefore transport and sell that on the contract to utilities, strong credit quality, well-established Japanese buyers. And so therefore a margin business, which also is significant because instead of a significant amount of the end product, the ammonia made into fertilizer, sold into the agricultural business, which is volatile, you're selling into it in a business and actually has a fixed margin, predictability, and stable earnings. So therefore converting not only substantial increment, because this would double the capacity the company has, and would do it in an economic project. The project itself is estimated to be somewhere between $700 to $800 million. This is easily going to be financeable, including places like the Department of Energy as part of the Inflation Reduction Act has a program to try to finance projects like this with a secure long-term source of the raw material, with a long-term offtake agreement by a high credit quality on the other side, therefore substantially reducing that risk. So therefore to be able to put 50, 60 plus leverage on this thing is easily digestible. And there are sources, including the US government, that will finance exactly this project. In addition, so therefore their estimated equity contribution is somewhere between $150 to $200 million. So this is, we think, a step change opportunity for LSB Industries. We think there's a high level of predictability and outcome for this. So that's what it is. Not only do we think of, you can buy the asset for 40 cents on a dollar, there's an identifiable path to probably outsized earnings over time, so therefore driving higher value. There are identifiable sources to grow the business as is, in addition to substantially increase the business. So this is a growth company, which is a critical element. Not only do we look to buy businesses that trade far below their current existing intrinsic value, as important, we realize the growth of the business and the growth in the returns are a critical element in how much this business is worth. So we think that not only do you buy the dollar for 40 cents, there's a really good chance that that dollar has the potential to compound to be 2 or 3 or more dollars. And so therefore, that's a critical element. The other thing I really haven't mentioned the management and the ownership. There's a substantial owner here who understands capital allocation. And there's a management team in place that we have a very high regard for, who again have done a phenomenal job of taking a troubled company from 4 or 5 years ago and turned it into something different than that, and has identifiable paths to continue to improve the business, and yet has also access to capital and opportunities to deploy that capital with high returns. So therefore, it is a company that we think has a competitive advantage, that has a better business with great growth opportunities that you can buy for a significant discount to what the business is worth. So better business, higher returns on capital, Ben Graham cigar butt pricing. So a combination of factors that we think to make it an extremely compelling investment. We do own the stock. We obviously own the stock. We've owned it for a long time. We know the situation well. We actually do own over 5% of the company. We have filed a 13D on the company. So that's well documented in the public domain. So with that, John, if you're still around, if I haven't bored everybody to tears, and after all, what am I? I'm the president, founder, and chief investment officer. We forgot to say chief cook and bottle wash too. So although I'm not, we all wash the dishes together. The 14 of us who do research and the 10 of us who also help and support us in that process. So it's an interesting place. Though I do love the community we have here at Robotti.
Terrific. Well, thank you so much, Bob, for such a compelling investment case. Very much appreciated. You talked quite a bit about earnings drivers going forward and why those earnings are likely to go higher. How should we think about, let's say, cumulative earnings over, let's say, the next 3 years or 5 years? Take whatever period you think is appropriate. How long will it take to get today's price back in EPS roughly?
So in 2022, right, this company, now the company over-earned in 2022, right? Events happened in Europe that there was a demand for ammonia and fertilizers, therefore kept, like in that chart we showed Yara. And so Yara kept high capacity utilization because they needed to make end product in spite of the fact that it cost them dramatically higher. So that drove pricing to be extremely strong. Now, in the United States, of course, pricing did go up dramatically too, right? Natural gas prices in North America did go from $2 to $3 to $9. So their cost of goods sold, went up also. And so that constrained it. But if you look back at what the earnings were in 2022, this company trades at 3 times what it earned that year. And so I think that that's, a little bit outsized, but I also think there are drivers that earnings will grow higher. So I think over the next, 3 to 5 years, there's a really good chance they could earn the current market price of the market cap of the company.
And so it trades roughly in line with book value. What does the book value consist of? What are kind of the main assets here?
The main assets are the physical plants of the companies on a depreciated basis. The plants they've owned them for an extended amount of time. So therefore, it is a depreciated basis. In the meantime, the plants themselves are in strong position, high operating rates, likely to continue to sustain that with relatively modest capital investment to therefore on the maintenance side of it. So that's what we do think, right? The assets are substantially understated on a book value basis, right? Because to create a company with 900,000 tons, that's what we think would cost somewhere between 1.6 to $2 billion. So, and that's relevant because we think the company has the potential, the new plants being built are being built for those kinds of numbers. And therefore the returns that are expected on those things make those justifiable investments. So that kind of gives an indicator that there's, that valuation has economic sense that's driven by current investments by people expecting that return on investment for that new capital that they're employing to build new facilities.
What would be some key data points to keep an eye on to gauge how the business is doing, how the thesis is playing out, and where in the cycle we might be in this industry?
Yeah, I do think the current environment is, the fertilizer business itself has been reasonably weak. And so, that's driven down earnings. And so that's part of what's depressed the stock price. And if we're made for the opportunity, we think that there's a cyclical recovery because we think that North America is extremely well positioned from an agricultural point of view too. And so therefore we would expect that business, continues to improve. And there's indicators that of course talk about, kind of where corn prices are. And, any one year can be a disappointment, but we think that that's a sustainable competitive advantage of fertilizer and agricultural businesses in North America. So their end market is one that we actually believe, although cyclical, probably has stronger operating environment outlook for the business. And so that's somewhat a critical element, of course, is what is happening with ammonia. What is the progression? So we continue to, of course, we're investors in the marine industry, so we're anxiously watching what is happening with the engine manufacturers in terms of the capability to create an engine design that can burn ammonia. But also the critical thing is, what's really going to happen with the substitution that initially it's the Japanese and the Koreans that, of course, are testing to therefore substitute in ammonia for coal. But obviously, if you can do that in that part of the world, you can do it everywhere else. And so therefore, the ability for that to gain traction would substantially change the ammonia business and substantially change the earnings power of the business because it's going to increase the intermediate price of that product because it has extra demands and therefore increase probably all the sales of all of their products because it'll be in sympathy with that. So that opportunity is one that looks as if it's developing and can develop very quickly. And that would be an important driver.
The shares were extremely low in 2019, early 2020.
Yeah.
Probably because of the balance sheet.
Yes.
Just tell us how that has strengthened over time through today.
Yeah, so the balance sheets, that's right. This was a financially distressed company for a number of years. What's really happened, as I pointed out, one of the two things. One is it was financially restructured a long time ago, probably even before that, when they raised money from a very high cost preferred with huge dilution in that process. That preferred has been converted into common stock, so the dilutive effect of that is behind it. Investor that made that investment obviously made a phenomenal investment with really high returns. Again, we think that therefore that means the largest shareholder here is someone who understands capital allocation, is extremely skilled at it. But what also happened in 2022 is, the substantial earnings of this company have fundamentally changed the balance sheet. So instead of one in which it was issuing debt at 9% when the world was issuing debt at 2%, 3%, today issues debt at 6% and actually buys that debt back because they think that's an opportunity for them in a world where interest rates are higher. So their cost of capital is totally different because the balance sheet is totally different. And therefore the strength of the company today financially to therefore be able to be opportunistic as opposed to be on the back foot and be defensive, which they were in 2019. So the company's balance sheet and economic situation, financial situation today is radically different. And therefore, again, in a position to be opportunistic.
I'm curious, Bob, how you think about, the position sizing in these types of cyclical businesses. You've known and owned LSB for a very long time, but have you kind of increased and decreased the position sizing based on, how enthusiastic or depressed other investors are?
Yes, and yes. And so that's what we really do think. One of the critical elements we think to success that we've had in the business is in the business, stay in the business, understand the business through all of the ups and downs and the volatility in that. But then as the situation, those latent earnings start to manifest and the opportunity becomes clear and obvious, the idea of then buying more makes all the sense in the world. right? Because you don't want to pat yourself on the back, and we've done that, right? So I've learned the lesson in the past. So maybe people have heard me talk about the company we invested in the late 90s, Ethel Corporation, that now is New Market, that changed its name, in that period of time. There was a huge opportunity there. We understood it. We followed it. We stayed invested when the things were really tough. When it got cheaper, we bought more. We bought more. We bought more. We did all of those things. And then when the business recovered, we said, there's a huge opportunity. The market still doesn't get this right. And we substantially increased our position, doubled our position, became a 13D filer in the company. The problem was that we didn't stay long enough to appreciate the full scale of that turn and the manifestation of the pieces that were in place, and therefore sold down that stock too soon and gave away money. Instead, the idea to have deployed incremental capital would obviously have been the right thing. With Builders First Source, which is a company, again, is a long-dated opportunity. When we first invested it, it went down. There was the situation was difficult. We got an incremental investment to also invest in a competitor at that time and to stay involved with that business, and therefore to continue to invest and invest even when it became a large portion of our portfolio, and to not sell it down because it was a large portion of the portfolio. Because my view is, you buy and sell a stock based on the price to value. And if the price to value is dramatically mispriced and the opportunity is manifesting itself, it's a better investment than it was when we didn't know when that would start to come together, when that opportunity would metastasize. And here it has. Therefore, it's a better deployment of capital. There's another company that I can't mention, but if you look back through my Form 4 filings, you'll see we continue to invest more money as the opportunity continued to appreciate. And so that's what we think is the right thing to do. It's the price to value. It's the realization opportunity. Those are the things that dictate, and therefore the sizing of the position is a less significant issue. As I guess, reading through recently, of course, with Munger's death, a number of the comments he has, and one of the concepts he has is there aren't many situations where you have it right. You know the situation, you know it well. And when you have those situations, you need to invest accordingly and back up the truck, and therefore be involved and not be sellers of those stocks, because it's finally come together. So, and you don't need many of those. And that's what we find. We haven't needed many of those, but we've had a few, and therefore, and being able to stay with them and potentially even invest more is we think the right investment strategy, in spite of the fact that from a portfolio allocation point of view, some people might be concerned about that.
Terrific. Well, thank you so much, Bob. I will leave it there. I would just encourage MOI Global members to feel free to reach out with any further thoughts or questions, either to Bob or the terrific team at Robotti and Company. We are also always happy to facilitate an introduction. Bob, truly grateful to you for taking the time to join us again and share this idea, as well as your deep expertise and experience with our community. It's a great value add, and I appreciate it very much.
Thank you, John. Appreciate it. Appreciate the opportunity to talk to you and the MOI community anytime and every time. Thanks so much.
Terrific. Goodbye for now.
Great. Bye-bye.